I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, Dr. Paul Craig Roberts, a former Assistant Treasury Secretary in the Reagan administration, also editor at Wall Street Journal, PhD in economics. Dr. Paul Craig Roberts, I know you have a very deep resume. I'm just skimming the surface, but thank you for joining us today on USAWatchdog.com.
Pleasure to speak with you as always, Greg.
You know, I've been listening to some of your other interviews that you've had out, King World News and other places. Good people over there, King World. Smart stuff, good content. And, you know, something that just struck me, just hit me, that when it all comes down to everything, when I'm listening to all your words and all the stuff you're warning about, that, you know, they're trying to get this, this Pacific trade agreement going, which doesn't look like it's going to work. They're trying to get a trade agreement to prop up the dollar, as you pointed out, in Europe, and with all the NSA spying, that's really hit a roadblock. It looks to me that to try to prop up the dollar this way, the president and his administration would have to have some real political capital. And it doesn't look like that's going to work out. And it's really going to come down to the dollar. Could you explain how these agreements to prop the dollar up don't look like they're going anywhere, and it looks like the dollar has pretty much, on the long-term trend line, nowhere place else to go but down in value?
Well, Greg, the fate of the dollar, of course, is the fate of United States power. And the reason the country is powerful is not for all the propaganda reasons, but because its currency is the world reserve currency, and therefore it's the banker to the world. It controls world finance. And because it can pay its bills in its own currency, it can print money to pay its bills. It doesn't have to earn the money through exports and having a surplus in the balance of trade in order to pay its bills, or at least a balance in its balance of trade. Instead, it can run continual deficits, and it can pay its bills by the willingness of the rest of the world to hold its paper currency, or to hold financial instruments or even real assets in the form of dollars. So that's the basis of the country's remaining power, and this remains despite the deindustrialization of the economy, despite the lack of any good jobs, despite the long drawn-out lack of recovery from a recession that happened 5 or 6 years ago. So this is the real crux of American power. Now, the whole question of the dollar's longevity depends on the willingness of other countries to continue holding dollars and dollar-denominated assets while the Federal Reserve prints $1 trillion a year with which to prop up the big banks and to finance the federal budget deficit. So it's unprecedented, the amount of money that the Fed has printed in the last 5 years, and the uses or the reasons for which they're printing this money is also unprecedented. So do these new developments affect how the world sees the stability or the desirability of the dollar? And that is not predictable. It may be they just would rather hold dollars that they're not very sure about than to try to find some other way. But the evidence we see is more and more proposals to avoid relying on the dollar. We've talked about it before, you know, the BRICS trying to make their own arrangements for settling trade between them in their own currencies, the agreements that China and Russia have made, that China and apparently Japan, unless we broke that up, I haven't seen, but we may have broken that up, but China and Australia, they are abandoning the use of the dollar to settle their trade accounts.
Even the European Union made a dollar, yuan, yuan euro swap agreement recently. UK has a swap agreement with China. I mean, It looks
So
like
these,
people are doing this not out of hatred to the U.S., but they're worried about the value of the dollar, are they not?
it's an indication they're looking to have to begin developing some other way to deal with international finance than to use the traditional dollar mechanism. And we see other types of developments. Recently, there was some conference in Asia, I don't remember the details, in which there was a proposal that gas supplies be traded not in dollars, but in the currencies of the different countries. So if you see this affecting natural gas, if it then spreads into oil, and you see the general move away from dollars in settling balance of payments between big countries, Brazil's a big country, China, Russia, India, these are very large countries. South Africa, which is of course the only really prosperous country in Africa. So it all looks like people are saying, well, maybe this dollar thing, we don't want to keep accumulating them. The indications recently are that in the last few months, both China and Japan have sold off some treasuries, some 40 billion between them. This is not a huge sum, but it does show that they are ceasing to accumulate them. And there's also been reports that China is accumulating very large quantities of gold. So this does show that the dollar may have a limited life as the supreme currency.
What is that? If you're thinking that the dollar is limited, time is limited, I think it's something that you said that as a world reserve currency, when the dollar does crack, and you're predicting a big takedown in the dollar, correct?
Well, it would seem that would be the case. Look, economics has supply and demand. And so what we've witnessed in the last 5 years is a huge increase in the supply of dollars, but we don't see the demand for dollars rising commensurately. Instead, we see people talking about avoiding the use of it, finding some other arrangements, just like we've been talking about in this discussion we're having now. And also we haven't seen any robust economic growth in the United States, which would increase the demand for dollars, or any robust growth in world trade, which would increase the demand for dollars as the world currency. So when you watch for 5 years the supply grow relative to the demand, then you have to say at some point there has to be a price effect.
In this case,
economists know that
value.
if supply increases and demand doesn't, the price has to fall. and it has a little bit, but there are various mechanisms of shoring it up. And so it really hasn't had the kind of impact that it would normally have in a supply and demand situation. So how long can it continue? Well, if miraculously the administration and the Congress get the deficit under control and it stops growing, or it shrinks down or consistently shrinks down, if the banks somehow can be put back on their feet so the Fed doesn't have to continue printing dollars to support them, then the dollar could conceivably survive.
Okay, well, that's the fairy tale. Now let's talk about the reality. They're not going to get their banks under control.
I don't think they will. But it's not totally inconceivable. They could stop the wars. They could do other things. But will they? I wouldn't bet my life on it. All I'm saying is it's not completely a foregone conclusion that the dollar will have a dramatic drop in its exchange value. But it's likely. And in many ways, the reason it hasn't already happened are these various interventions. For example, the gold market. We've talked about it before, you and I, Greg, that when the gold price in 2011 started approaching $2,000 an ounce, it hit 1,900. The Federal Reserve realized that if the price of dollars in terms of gold is changing that rapidly, sooner or later, the exchange rates of other currencies in relation to the dollar had to change. So they said, we've got to stop this rise in the price of gold, or the dollar is going to drop in terms of other currencies, just like it's dropping in value in terms of gold. So they began shorting gold in the futures markets. They sell naked shorts and they drive down the price. And now they seem to have capped it. Again, they've been selling these naked shorts the last 2 days. It dropped $17 an ounce today, $17 an ounce yesterday. So they kind of have a cap. So how long can that go on? I don't know. I don't know how long it can go on. They have other ways that they support the dollar. They get currency swaps, and as we've talked before, they try to get trade agreements. The Trans-Pacific, the Transatlantic, which essentially wrap people into the dollar mechanism. That's really what they do. So all of this, I think, has been successful in the sense of delaying the reckoning that the dollar will ultimately face. Now, how long can they delay it? I don't know.
If you were going to guess, would you guess?
I think they've hurt their position because of the spying, because now everybody sees they're not trustworthy and people are mad and they've been humiliated. Our best allies now have to acknowledge that they're even spying on their private cell phones of the Chancellor of Germany, the President of Brazil, it's the French president. It sort of hurts their opinion that they're important people. And here they are being spied on, just like some Al-Qaeda terrorist or some American journalist who has some leak or something. So this kind of humiliates them. This changes their attitude toward the United States. They don't see themselves being in a favored position when they're spied on like this. We also have the humiliation that the Obama regime suffered over Syria. They were going to attack Syria. They had it all set up, and the world stepped up and blocked them, just blocked them cold. And they had to back down. We saw on the 30th of October, 2 days ago, the leading newspaper in Canada said that when Cheney shows up tomorrow to speak at this global conference in Canada, arrest him. He's a war criminal. We can't protect American war criminals. It's against the law. And so you see this is decimating the prestige and the power of the United States. And also recent Chinese statements were very, very strong, very powerful about the need to de-Americanize the financial system, that how can you trust a financial system that can't keep the government going, that has the government shut down, that can't resolve its debt problems, and that leads the world to war based on lies. Now, that's a very undiplomatic statement. So you're seeing this everywhere. You're seeing in South America, several countries are trying to have the United States brought to court for human rights violations. You see the Brazilian president saying we have to have our own kinds of internet systems so that they can't spy on us. You see the EU has said we're going to block the SWIFT information that's to do with bank clearances in Europe from the Americans. So all of this makes it very difficult if there is a run on the dollar for the Treasury and the Federal Reserve to call up these foreign governments and the international organizations and other central banks and say, quick, help us stop this run, help us stop this run. Go in and buy dollars. So I think on the whole, we're getting closer to a reckoning. And
for the dollar.
For the dollar.
Well, let me ask you another question here. I want to get this in. Could there be a sudden devaluation of the dollar? I mean, some people like Gerald Celente of Trends Research says he's guessing that they're going to, you're going to wake up in March of 2014 and, yep, we got a bank holiday and we're going to devalue the currency by, at least the amount we did it back in the 30s, which was 70%. I mean, could that happen? Or could we get a new dollar to prop this up?
Not if you're the reserve currency.
You can't have a cut in value.
No, you have to. If you're willing to at the same time give up the reserve currency role, you can do something like that. But that's inconsistent with saying we're the banker to the world and we're the reserve currency. I don't think the United States government would be the one that devalues the dollar. It happened in the exchange markets. Well, the currencies are freely traded in the exchange markets, and it'll be the decisions made by foreign countries and American citizens that they don't want as many dollar-denominated assets. And when they sell the assets, they have to then take the dollar proceeds and sell the dollars in the foreign exchange markets. It doesn't do any good just to say, oh, I don't trust treasuries, I'm selling the bonds. Because the Fed can create money and buy the bonds and keep the price up, which they've been doing now for years. But the Fed cannot print foreign currencies to buy up dollars. So the crisis comes not when stocks and bonds are dumped, but when the dollar is dumped. When people sell stocks, sell bonds, dollar-denominated stocks and bonds, and then they turn around and sell the dollars. That's what the Fed cannot control. And when that happens is when you have the beginning of the dollar collapse. That is the beginning of the end. Now, when the dollar drops in exchange value because the United States economy is now import dependent, it means domestic prices rise. See, all the offshore goods that come in, all the foreign-made goods on which we're dependent, everything in Walmart, you see, those prices rise when your dollar drops in value in relation to other currencies. So then you not only have the drop in the dollar's exchange value, but you have a rise in the domestic price level. And the two things together really panic people. And you'll see then you'll get a real flight from the dollar, and and the Fed won't be able to stop it. And so that is when the end comes. When you reach that point, it's too late. There's nothing you can do at that point. And that's where it's all headed. Now, does the Federal Reserve understand that printing $1,000 billion a year to support the banks and the bond prices and the government's deficit? Do they understand that that is eroding confidence in the dollar?
They must.
I don't know. Probably they do. But you see, that is a long-run problem. And the short-run problem is we've got to support the banks. So as I've said before on your show, the real reason for quantitative easing is to keep bond prices very high because all debt prices rise together. So the higher the treasury price, that is, the lower the interest rate on treasuries, also the higher the debt-related derivatives on the books of the banks.
What they're counting as money, assets.
Well, it's their balance sheet. So the prices on their balance sheet are kept up by quantitative easing. That's the main reason for the policy. The main reason is not what the Fed sometimes says, oh, we're trying to support the economy and jobs. What they're doing is supporting the solvency of the banks because the banks hold all these debt-related derivatives and nobody really knows what they're worth or how the bets are covered. And so if you drive interest rates very, very low, it raises the price of all debt instruments. And that's what's been going on. So the Fed says, well, let's assume the Fed knows that it's eroding the dollar or the confidence in the dollar by printing too many of them. It has to say, well, if we stop, and that means if we stop buying 1,000 billion bonds, interest rates are going to rise. Why? Because the bond supply is not changing, but our demand is coming out of the market. So the price will go up. And so what happens if the price goes up? Well, the bond market will collapse. The stock market will collapse.
And then the price will go down. The value of
banks' solvency will go down. So they say that is an instantaneous crisis. It'll happen as soon as we do it. Whereas this other crisis with the dollar is off in the future somewhere. So
but that's still going to be a crisis. I mean, there was a famous quote.
It seems to me that way. It seems to me that there's going to be a crisis, and the longer they avoid the short run crisis by supporting the banks and printing dollars with which to buy bonds, as long as they do that, the longer they do that, the more pressure they're putting on the dollar, and thus the more likely they're going to cause the long-run crisis. But they're trapped. I see, you can't expect them to say, okay, let's blow up the world right now so that we don't have a crisis with the dollar next year or the year after, you see, or the year after that. So they keep it going. They're trapped. They're trapped. That's just why I don't think there'll be any quantitative easing, any tapering of quantitative easing. Now, the one thing, so that people just don't think there's no chance at all. Again, if somehow Washington can get the deficit reduced and on a falling path, and if it can take other steps to regain the confidence of the world, for example, if it reins in the NSA and says, okay, this is it. This has gone too far, and we don't need this anyhow. What good does it? What does it have to do with terrorism to spy on the chancellor of Germany? Nothing. If they were to find some humility and quit being so arrogant with regard to everybody else, and simply say, okay, we've overreached, we've done too much, we're ruining it for ourselves. We've got to rebuild. We've got to get rid of the wars. We can't afford them. We've got to stop all the spying. In fact, we can't afford that either. I mean, it's a very expensive operation. And we're doing other things, and we've got the deficit path going down. And so the Fed won't need to buy so many bonds because we won't be issuing so many new ones. And somehow we'll find some other way to support the banks. Instead of trying to support them by buying bonds, we'll just print money and give it to them under the table. Or we'll just create reserves for them with an accounting entry. So, and stop trying to support them in this stupid way, which is eroding confidence in the dollar through time. So you could do something that would stabilize it and let you perhaps recover the situation in the longer run. Now, one of the real problems in the way with that being successful is they've offshored so much of the economy. There's just not any jobs. There are no good jobs. And now Obamacare, which they say is going to reduce the deficit, has actually resulted in millions of Americans who had full-time jobs now being put part-time work because the employers want to avoid responsibility for the health care requirements under Obamacare. So the steps that they're still taking steps that are deadly to the economy. They're not, see, there's no sense there. There's no intelligence anywhere in Washington.
I know that.
Not in the economic advisors, the Treasury, the Fed, the Congress, the White House. None of them have any sense.
I know you're painted a nice picture of how we could get out of this, but come on. I mean, we're blowing up the federal deficit even more, and I mean, thank you for giving us some ray of hope that they might be able to pull this out, but that's not going to happen. I don't think they're going to cut back on the spying. They may say so. My last question to you, a famous quote, I don't know who said it, but they said, it was a head of state, and they said, how did you go bankrupt? And the person said, well, first slowly and then suddenly.
Yeah.
Two ways. First slowly, then suddenly.
Yeah.
Now, we've had the slowly. If they keep doing what they're doing, aren't we going to get the suddenly?
Well, that's what I've said. Yeah. If they keep doing what they're doing, it's unavoidable.
And at some point, snap, boom, the dollar crashes, right?
Snap boom. It can be snap boom. So, but you see, look, I'm not trying to create any false hopes, but suppose the rest of the world simply comes to Washington and says, look, you guys, this doesn't work anymore, and you're going to have to do this, that, or the other, or you're going to get snap boom tomorrow. So we're here with an ultimatum. You got to get your debt under control, stop printing money, stop supporting the banks in this artificial way that screws up the financial markets all over the world. And if you don't do that, it's snap, boom, you're finished.
The dollar's gone.
Dollar's gone. Now, this is not inconceivable. On the other hand, all of these countries may have come to the conclusion that they found a way around. They may be working out whatever the difficulties the BRICS were having, working out the arrangements. They're probably having fewer arrangements after the recent experiences with the United States, the spying, the government shutdown, the inability to deal with the debt ceiling, and all the rest. So it could well be the rest of the world has already decided that they're putting in place new arrangements, and then the snap boom will happen when all the new arrangements start up working.
Of the dollar crashing.
Yeah, I mean, if all of a sudden the largest economies in the world no longer dealing in dollars, it has to affect the price of the dollar in exchange markets. It'll just be a snap boom thing. So it may be the snap boom comes when all the alternative arrangements are put in place.
That's what it looks like.
It looks like they're being put in place. It does look like it. As you pointed out earlier in this conversation, it was unprecedented for China, the Chinese Central Bank, and the European Central Bank to have a currency swap arrangement. And also, I think, unprecedented for the Chinese Central Bank and the Bank of England to have one. So this shows the movement away from American financial hegemony. You can't have financial hegemony when other countries are saying we're making our own arrangements in these new ways. These are new developments, and they clearly imply that the rest of the world is looking at the dollar with a jaundiced eye.
Paul Craig Roberts, Ph.D. in economics, former assistant Treasury Secretary in the Reagan administration, father of Reaganomics. Really appreciate you coming on today for an in-depth interview to talk about the dollar. I appreciate you coming on USAWatchdog.com.
Well, Greg, I appreciate your shows. I'm sure many people do.
Thank you for coming on, Dr. Roberts.
You're welcome.